DBS second quarter profit tops forecast, rising 6% to 2.79 billion as wealth fees surge. Now the headline really looks fantastic, correct? I looked into DBS books, and while it may not be as fantastic as the headline screams, I still think it's not too bad. Here's why. Hi guys, welcome back. Today you'll get a full deep dive into DBS like you have never seen before. So before I get there, help me smash the like button early because you know I have the goods. Now if you're looking to really understand DBS business, I hope to break it down into very simple layman terms for you to understand. Having said that, it's all very numbers because this is a bank, correct? So the first thing I'll start with is second quarter net profit year-on-year comparison. Total income rises 9%, as the header suggests. And at the bottom, I've labeled 1, 2, 3, 4, which is actually the 4 key profit segments. Number 1, net interest income. I'll touch on it right to the very end. Second, fee income, which includes wealth management. The third, treasury customer sales and online income. I took a while to understand that and hopefully I can explain to you in simple terms. And the fourth is market trading income. As you can see over here, all 4 cylinders are firing well, as the headline suggests. But again, this is year-on-year comparison. And that's why it's important to look quarter on quarter. Next up, let me show you comparison between second quarter 24 versus first quarter 24. As you can see, the header now reads profit is down 5% quarter on quarter. Number 1 and number 2 still remain green, but number 3 and number 4 now have turned red. So let's try to understand it. Let's start with treasury customer sales and other income sales. I found this description to try to help explain what does this segment actually mean. A bank's treasury division manufactures a wide range of financial products that are offered to a wide range of customers, from the largest corporations to the retail investor, which means large corporations need credit facility, need FX exchanges, retail customer needs stock trading facilities, margin account, products, etc, etc. So with that understanding, let's bring up data points for treasury customer sales. I've taken their latest screenshot and added on the right hand side a comparison with quarters before this. So let's go through it now. As you can see, first quarter 24 and second quarter 24 look very nice, correct? The beige bar, which is CBG, Consumer Banking Group, and IBG, Institutional Banking Group, have delivered above usual customer income. How can we know? Because if we compare against all the other quarters, which can date back to first quarter 22, you can see that usually it hovers around $400+ million. But first quarter delivered 613 million, while second quarter delivered 564 million, even though it slid slightly. This 2 quarters outperformance could be due to the strong equity market performance that we saw in the first half of the year. If markets correct, I believe that these 2 segments could tail back down to the 400+ million range. So if what I say is correct, then next few quarters, this could drag down performance a bit. Having said that, I believe that banks, including DBS, can manufacture products for all seasons. Where equity markets go up, sell a lot more derivatives and structured products linked to the equity markets. Where equity markets come down, sell more hedging related, FX related products. But all in all, I do think that first quarter 24's 613 million in the beige bar is a near-term high point. Let's now move on next to fee income. DBS, like all other banks, makes money not just through lending but also in all other services. This screenshot over here explains what kind of services DBS makes. And right at the bottom, transaction services. This is bread and butter, doesn't grow very much. Up next, credit card service, which actually jumped quite a bit, and that can be attributed to the recent consolidation of Citi Taiwan into DBS. As mentioned over here, card fees increase because the customer base is bigger, and wealth management also increased because the customer base is bigger. Just nice also, equity markets were very nice for the first half. So let's pull back our table over here. You'll see that loan actually increased also, quite good. And mainly, as what the header suggests, wealth management is the one that shot up. Previous quarters, 300+ million, but right now, $500+ million. In my opinion, this jump is due to inorganic growth, which is the acquisition of Citibank Taiwan. And as long as staff costs don't go out of hand, expansion usually works. DBS is not the only bank acquiring. UOB has actually acquired a piece of Citibank Southeast Asia. So all in all, I feel this fee income increment is due to inorganic expansion until the next acquisition come, I don't think there will be big jumps in these few segments. So with that, let's move on to the biggest pie of DBS's profits, which is actually on net interest income. All three Singapore banks made record profits when Fed raised interest rates in the last few years. The reason is because when Fed hikes rates so quickly, banks have a lag in terms of what they pay depositors in their interest rates, but now very quickly they can hike up when they do commercial books based on Fed's overnight rates. So moving forward, when interest rates come down, there's the risk that this net interest income would naturally be squeezed downwards. How much drop would that be? I think this is where I'll bring up findings listening to CEO. He's mentioned specifically that group net interest income growth is expected to be single digit for this year because Fed hasn't cut rates yet, right? So net interest income drop hasn't taken place. And if it does drop, he's given a figure which is about 4 million per basis point of Fed funds rate. Back in 2021, every basis point that Fed raised rates, they made 18 to 20 million more. That's how much money banks made in that Fed rate hike cycle. What he's mentioning now is that the jump was fast, but the coming down would be quite gradual, which is hard to know for shareholders. But again, 4 million per basis point of Fed fund rate is still not a small amount. If Fed funds rate dropped from 5.25% to 3.25%, a 200 basis point drop, that will mean 4 million times 200, which is 800 million less profit for DBS in this period. He's mentioned also in the green arrows I've indicated over there, listening to him, that specific allowances can be trimmed a bit downwards, which could add to profits. And that full year 2024 will be a record year. Explaining more on net interest income, I found further notes. They have noted that CASA ratio, which stands for current account savings account, has dropped from 52% of deposits to only 46%. That's because many depositors like you and I have moved towards fixed deposit and are not keeping in current accounts and savings accounts, which means downside impact on net interest margins. So how does DBS actually hedge against this upcoming business challenge? As mentioned next, they have sold more fixed rates in their commercial books, and now it accounts to 35%, which means you try to lock in customers at a fixed rate so that the rates are fixed even if the floating rate starts to drop. This again is smart business moves. With that said, let me share with you my conclusions on DBS. The first is the 10 billion profit mark for 2024 is all but certain already. It could look closer to 11 billion in fact. Net interest margin is still strong because Fed has yet to cut rates. The second conclusion, actually what we need to focus is 2025. Whether there will be a drop in DBS's profits really depend on how aggressive Fed will cut rates. As mentioned just now, if it's a 200 basis point, which is 2% drop in Fed funds rate, that will mean an 800 million profit impact to DBS. So you may be thinking, Fed will cut rates that aggressive meh? How could that be? Actually, if you think about it, if there's really a recession, there is a possibility that rates could be cut very quickly. In global financial crisis, they lowered it almost to zero. In COVID crash, they lowered it very quickly again to zero. So never say never in terms of a rapid rate drop. What kind of impact does it look? Let me pull out for you some old data points, which is actually from financial 2020. You would see that net interest income shrinks, and also there's more provisions needed for bad debts. That's why DBS in the period recorded a minus 26% in terms of profit. This reinforces what I've mentioned on the channel many times, that banks are inherently cyclical. Having said that, DBS, UOB and OCBC are all very, very good franchises to own. But if you see in terms of share price, why did it drop 12% in 1 month? The reason? Right now even sits lower than when it did its bonus share issue. The reason is because market is pricing the risk of possible recession in 2025 and its impact to banks due to default rates and also in terms of cut in interest income. That is real risk, and hopefully with my explanation now, you kind of understand why markets have reacted so strongly. If you have learned something already, help me smash the subscribe button so you can get to 60,000 subscribers. And as DBS, UOB and OCBC release new results, I'll be happy to share them with you over here in this channel. Now I'd like to reiterate again, I'm not saying sell your DBS shares. And I'm also not saying wait until recession then buy. Because again, we don't know when recession comes and we don't know how deep the recession will be. I'd like to go through all these factors with you so you can make a more informed decision before you buy your DBS shares. Consider very clearly what is good value. Don't just see in terms of share price, which is what the surface investor would do. Everybody in this chart can see that DBS performed twice as well in terms of share price than OCBC. The question now is, at this juncture, do you get better value with DBS or OCBC if you're keen to buy into bank stocks? A quick comparison between the two of them would suggest that on a price to book basis, both are expensive. They're trading near to the +1 standard deviation in terms of price to book value. When COVID hit, both were trading below book value, DBS at 0.89 times, OCBC at 0.78 times. So it's not true that they will never converge. And looking at this, OCBC's current price to book is only at 1.12 times versus DBS at 1.46 times. If you feel that both franchises are very good, or that OCBC's acquisition of Great Eastern actually diversifies its earnings even more and can bring growth to the group, then why not do some homework first on OCBC and decide which has better value. Then next, if you really like DBS shares, you want to buy it, let me share with you some value points. Because as what Warren Buffett has said, price is what you pay, value is what you get. I've calculated for you, if you want to buy at an average price to book value, what to pay for DBS. At an average price, you should be paying only $31.30. If it hits this figure, maybe you can consider buying and not regretting. After all, it's still fair value, you're not really overpaying. But if it doesn't come, then also don't rush for it because market always overreacts to recession risk and stuff. Let that work in your factor. That's something I've always tried to highlight. Then the next point is, if you want to buy DBS at a distressed price, -1 standard deviation, that target price to acquire will only be at $26.50. Having said that, if you only want to invest at such distressed prices, take note again, it will only come down to this when there's disaster, there's real fear in the market, correct? Oh, there's going to be some credit risk, some deep recession, yada. And when such things happen and banks trade at such a price, it could be depressed for quite a while. As you can see, I've mapped on the right hand side, Mapletree Industrial Trust now tracks is now priced at -1 standard deviation. This really answers the question, Josh, why are you buying REITs instead of buying banks? I've seen that question many times. I have the risk appetite to buy when it's distressed, but also when it's distressed, it doesn't mean you recover immediately. This has been a 3-year plus bear for REITs. So hopefully I've given you clear insights, what price is fair value, and the more important part now is how you take action. Let me know in the comment sections what you've learned from today's discussion, and as always, thank you for watching right to the very end. With that, I'll sign off from here and see you in future videos. Invest safely. Goodbye.